Hey, Jason here. Today's video, I'm going to answer the question, should you buy robotics stock, iRobot, stock ticker IRBT? This is a stock analysis for Ocean, who requested this on YouTube. Before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and release new videos all the time. You see my other videos, I don't want to do this, but I have to do this because every time I don't, I get nasty comments. This is for your informational purposes only, to help you learn how to better and faster evaluate stocks. These videos are at the request of viewers, and because of that, I often don't know what the company does, and if I don't, I purposely keep it that way. Why do I keep it that way? Because I don't want what the company does to bias me in any way, negatively or positively. That also means I don't care about the company's story. That doesn't mean it means I don't care about what the CEO says the company is going to do. At this stage of my analysis, I need margin of safety, which comes in the form of high profits, high cash flow margins, high returns on invested capital, balance sheet strength, low debt levels, undervaluation, these kind of things. I don't short sell ever, or I also don't short sell ever, so I don't benefit from any stock I talk negatively about. I also don't own any stock in a positive or in a long position, any stock I talk positively about. Again, I don't benefit from this either way, so this is done completely for your benefit, to help you figure out how to evaluate stocks better and faster. Why should you listen to anything I have to say? Because in the first 9 years of my career, I've produced 23.5% average annual investment returns in the portfolios I manage. This puts me just behind the great Warren Buffett, who produced 24.2% average annual investment returns in the first 9 years of his career at his Buffett Limited Partnership. I've almost tripled the market in the last 9 years, and my numbers legitimately will make me one of the best stock pickers in the entire world over the last 9 years. I'm not saying it is to brag. I'm just saying it to prove to you that I actually know what I'm talking about a little bit. Okay, again, apologize for that. Don't want to do it. Have to do it. Okay. So today's stock, I know a little bit about what this company does because I own one of their vacuuming robots. I guess that's probably the best way to put it. So I know a little bit about what they do, but not much. I've never evaluated them from a stock perspective. First thing, $2.22 billion company, forward PE of 36.9. I don't care for forward PE at all, but when I do, I want to see this number under 20 to show the company might be undervalued. This at 36.9 is one sign the company might be overvalued. Okay. Description. iRobot Corp is a US-based consumer robot company. It designs and builds robots that assist consumers with the solutions for the activities to be carried both inside and outside of the home. The company's consumer robot comprises a portfolio of solutions which includes cleaning, mapping, and navigation, human-robot interaction, and physical solutions. The company operates in the business segment of consumer robots. The consumer robot products are provided to consumers by retail businesses and online stores. The company primarily derives its revenue from the product sales. It sells the products across the United States and around the world. That is a terrible written paragraph. But what that really means, and what's most important, again, iRobot, they make other stuff other than this, but most people know them for the vacuuming and vacuuming and mopping robots to clean your house. That was a lot simpler than the entire gigantic paragraph right there, wasn't it? Okay. They have an enormous amount of employees. That's a bit surprising for the size of company that they have 1,300 employees. It's not necessarily a bad thing. It's just something of note. You typically don't see that many employees at this size of company. Okay. The revenue has skyrocketed from 2011 at 466 million to the trailing 12-month period at 1.63 billion. Frankly, that's not surprising. Their products have become better over time, and more people, and their prices have come down, and people are adopting these more. Again, I have one of these in my house. I thought it was going to be, frankly, when my wife bought it, a terrible waste of money. It's actually one of the coolest things, most useful things she's ever bought. So I do like their products. Their operating margin is actually reasonably good. I look for anything above 10% on a consistent basis. Well, last decade, this is average, probably off the top of my head, about 6, 7, 8%. So it doesn't meet my threshold, but it is, frankly, a little surprising it's that high. I expected with a kind of tech/robotics company this operating margin to be negative, frankly. Uh, Pleasantly surprised that it's positive, and positive to a pretty good degree. They have issued about 1 million shares in the last decade. That's not a huge deal, so I'm not going to spend time talking about that today. Their book value per share has skyrocketed. That's very good, typically. From $8.27 per share in 2011 to $27.85 per share in the trailing 12-month period. I said this is typically a good thing because while book value is not as important as it used to be, it still is one sign that the company's underlying intrinsic value is going up over time. And over time, when that happens, or long term, when that happens, the company's share price typically goes up. We will need to watch out if there is any goodwill on this, and I'll explain why if and when we get to that. Our ROIC is fantastic. I would look for anything above 10% on a consistent basis here. This is at 14.1% in the trailing 12-month period. In the last 10 years, there's only been 2 years that it's been below 10%. And they're over that entire decade, again, I'm just kind of ballparking here off the top of my head, probably 11, 12, 13%. So that meets my threshold. That's actually not only very good, but frankly, a little bit surprising, again, for the reasons I talked about earlier. Free cash flow to sales, also good. I look for anything above 5% on a consistent basis here. They're at 10.5% of the trailing 12-month period. And in the last 10 years, this has probably averaged 7, 8, 9%. Again, so that's fantastic. This is surprisingly surpassing most of my thresholds for potential investment so far. Good amount of cash on the balance sheet. Okay, so I've seen one problem here already. We need to check with the cash conversion cycle. Their accounts receivable only makes up 6.6% of their balance sheet in the last quarter, while the inventory makes up 24.4%. We'll check this when we get to the next tab, but in general, companies' accounts receivable and inventory should go up or down at about the same rate. If they don't, it could cause major problems, and we'll talk about that if we see that on the cash conversion cycle. Other than that, they don't have short-term or long-term debt according to this. That number's been wrong on the last few analysis videos, so I need to check that on the actual balance sheet when we get to that. Okay, so this is a problem. For iRobot, their cash conversion cycle has gone up from 11.1 days in 2011 to 51.1 days in the trailing 12-month period. That is a massive increase. What that means is the company is having a harder time selling their stuff. How do I know that? Because their days inventory has skyrocketed. It's gone up from 39 days in 2011 to 79 days rounded up in the trailing 12-month period. That is more than doubling of the amount of inventory they have in stock in the last decade. That is a massive issue. Why is that a massive potential issue is how I should phrase that, because we'll see more when we get to the balance sheet and cash flow statement. This is a massive potential issue because this entire cycle measures how long it takes to sell stuff, or how long it takes the company to buy stuff from suppliers or build and manufacture or whatever. Then it measures how long it takes to sell that stuff or to turn that stuff into inventory. That measures how long it takes to sell that stuff, to get cash, to complete the entire cycle, and it's called turning the inventory. When this goes faster, let's say this went from 11 days to 1 day, that would be a sign the company is becoming more efficient. This is a sign the company is becoming less efficient. When this happens, typically it shows up in the company's margins. It is not here because the margins have shows up a little bit in the operating profit. Actually, it does show up a lot in the operating profit. Their operating profit in 2011 was 11.5%. In the trailing 12-month period, it's about half that at 6.1%. So it is showing up there. Let's go back to ROIC. Their ROIC is low over the last decade as well, so that is showing up there and not showing up in the free cash flow to sales. So what this means is not only those things that we just talked about, but it could also mean that the company, because they're having a harder time selling stuff, it could mean they may have to discount their stuff at some point. If and when it has to do that, that means lower sales, that means lower profits, that means lower cash flows, that means lower profitability in general. That's why this number is so important, especially for hard asset companies like this one. That's why it's so important. Again, we'll see more when we get to the balance sheet and the cash flow statement, but this is a potentially gigantic red flag for all the reasons I just talked about. Okay. Hopefully the balance sheet is working and the quarterly is working. This was not working on one of the last videos I did. There we go. Okay, decent amount of cash, about $420 million in cash on the balance sheet. They're a $2.2 billion company, so that's roughly 20-25% of their entire balance sheet is made up of cash. That's a pretty good margin of safety. Do have some goodwill, but it's a nominal amount. So what that means is the underlying, it's a good sign that their book value per share rising is going up, and it's actually increasing the value of the company over time. That's a very good thing, and I've talked about why, if they have a ton of goodwill and they've gained goodwill since then to do that, it's not a good thing. But I'm not going to get into that video because it's not a problem, or get in that today in this video because it's not a problem. Okay. Nominal debt, short term. What about long term? Nominal debt, long term, they have about 60 million ish in short and long term debt and capital leases. That is a minuscule amount for a $2.2 billion company. The balance sheet is very clean. Interesting. Let's go back up and take a look at accounts receivable and inventory in a little bit more depth, though. So where is inventory? Oh, went down too far. Okay, inventory is about $280 million worth right now. Their accounts receivable is down to about 70 million. Again, these should rise or fall at about the same rate. What this shows me, combined with the other stuff we saw earlier about the cash conversion cycle and the stuff on the balance sheet, is either, it could be a couple things. They have more competition, which is certainly true, because more and more companies are releasing these kind of robots. So that's definitely part of it in my estimation. Another thing that this could lead to, again, having to lower prices, which leads to lower sales, lower profits, lower cash flows, all that stuff. If they can't get this fixed over the long term, this could be a gigantic problem for the reasons we talked about. I don't know enough about their competitors to frankly make a judgment on this. But here is an illustration of this. In 2016, I'm on the annual numbers now. In 2016, they had about 50 million in inventories. Now that was at 280 million, I think, on the quarterlies. And their accounts receivable has gone up slightly in that time while their inventories have skyrocketed. Again, signs to me that they may be facing some of the potential stuff we're talking about. And if we are to do a further case study, that's something we would definitely want to figure out. Okay, cash flow statement now. changes in inventories right here. They've added that this again. I have other videos about this in our masterclass, but these numbers are inverted. In many cases on the cash flow statement, it doesn't actually show here. But this means they've added about $143 million in inventory in the last year. Again, I'm assuming that's because that's how it always has been, but they keep changing their stuff on Morningstar, so that might be incorrect. But again, this is why I calculate the numbers myself when I do things like owner's earnings as well. Accounts receivable. Okay. Nothing of major note on their cash flow statement other than this sale of an investment for about $64 million rounded up. That's interesting. I would want to kind of know what that is, just out of curiosity more than anything, but nothing of super importance otherwise on here. Ooh, I spoke too soon. They issued some shares, about $50 million worth of shares, which we saw. That's not a huge deal, but that is also of note on here as well. So far, I would say this is a no-go because of the potentially massive red flag with the inventory and accounts receivable and competitive issues or potential competitive issues, more competition, lower profits, all that stuff. But let's go see here on the valuation tab, which I already have open. Okay, and yes, so we will not be doing a further case study on this. I can already tell they're overvalued based on this number down here, but let's get to this first. Again, I don't care much for PE, price to cash flow, or forward PE. When I do, I want these to be under 20. PE is 20.6. Price to cash flow is 11.2. Forward PE is 36.9. These show it's slightly overvalued, but this is the most important number down here. Enterprise value to EBIT. I look for anything under 8 on this number, and this is at 18.9, showing the company is significantly overvalued. So with this considered, with the potential issues with the cash conversion cycle, inventory, all the stuff we talked about at length, I would not do further research on this company. It doesn't meet my minimum thresholds, my minimum criteria for what I look for from an investment in the portfolios I manage, even with their large margins that do mostly meet my thresholds. Does it mean it's a bad stock? No, it just means it's frankly doesn't meet my strict criteria, which most companies do not. Okay. So I hope you enjoyed this. Again, Ocean, thanks as always for your stock recommendations. Always appreciate it. If I missed something, if I didn't explain something well enough, I should explain something better, let me know in the comments below. If you want to, oh, I froze up in my back. Okay, I apologize for that. I froze up on my screen. If you want me to look at a stock like this for you, I'll do so anywhere in the world if it meets 3 criteria. Can't be a bank because I don't evaluate banks. Can't be an insurance company because you have to actually dig into 10Ks to evaluate insurance companies, and it has to be producing revenue as well. Why does it have to be producing revenue? Because I did some analysis videos on companies that weren't producing revenue, and they were frankly quite boring because of what I said at the beginning of this video. I don't care about the story. I don't care about what the CEO says the company is going to do. I don't care about any of that until far later in the analysis. At this initial stage, it has to meet certain criteria that we just talked about. But if it meets those 3 criteria, let me know. I'd love to look at a stock anywhere in the world for you. We are giving preference to masterclass students now, but I don't see anything on the calendar from masterclass students. So if you want me to look at a stock anywhere in the world for you and it meets those 3 criteria, let me know and I will add it to my calendar. If you're looking for more specific help on how to become a better investor faster, make sure to check out our free resources below this, including our 5 free gifts, which you can get our free free preliminary analysis worksheet, which you've seen in some of the other videos. If you've seen the other videos, you can get that for free as part of our 5 free gifts. You can also get a free PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those for free at the links below. If you're listening on YouTube, thanks so much. Very much appreciate it. Make sure to like, love, share, subscribe, comment, all that good stuff. And if you do subscribe, make sure to hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you're listening on the podcast, again, thanks so much. Really appreciate it. On the podcast, we really appreciate all that same stuff as well. But we have a special request on the podcast. If you could leave a review, we greatly appreciate it. Why? Because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our newly relaunched masterclass. We're already getting students in. And as of this recording, we still have some spots left open for $9,000 in free bonuses we're giving away to the first 10 students who join to our newly relaunched masterclass. We have 2 students for sure in, another 2 potentially coming in. So we have potentially 6 spots taken as of this recording. But first come, first serve. Whoever gets in gets those. And if you're in the first 10 members to sign up, you get those $9,000 in bonuses for free. But until next time, have a great day. Talk soon.